Leaders of three of the top U.S. banks have warned that financial markets could be headed into bubble territory, despite reporting bumper profits in the third quarter well above estimates. The CEOs of Goldman Sachs, JP Morgan Chase, and Citi warned that investor exuberance risked stock markets becoming unsustainably high. Thomas J. Hayes, as the chairman of Great Hill Capital, he joins me live for more on this from New York. Tom, great to speak to you about this today. So what do you make of these concerns that these banks are raising about the financial markets and how they could be a little bit frothy?
Well, I think there's something to that, Steve. If you look at JP Morgan, obviously all the banks beat on the top and bottom line, JP Morgan, Wells Fargo, Goldman, Citi. But JP Morgan's credit losses for the third quarter were $3.4 billion, which was the highest since the first half of 2020. He also referenced the bankruptcies of Tricolor, the subprime auto lender, and the bankruptcy of First Brands, which had $10 billion of debt. That was an auto parts supplier. So there's maybe some hidden risks, particularly in the private credit market, that they're alert to. And then if you look at the Bank of America Global Fund Manager Survey that came out this morning, it was cited by fund managers managing about $500 billion, 400-something managers, that the AI bubble was the biggest risk to the market. So on the one hand, we have a barbell. We look at bank earnings, which shot the lights out on deal making and on trading. On the other hand, we still have yet to hear from tech. And this is going to be the first quarter that their earnings growth has actually fallen by half, from 32% in Q3 of last year to about 14% this year. So that guidance is going to have to be really, really good to keep these multiples as high as they are on tech stocks, because the earnings growth has decelerated, but the multiples have not yet come down. And I think that's what these CEOs were referencing on the earnings calls today.
And tell us a bit where these concerns lie then. You mentioned credit losses there. Could you elaborate on that and what that would indicate?
Well, it's a warning shot. They could be discrete one-off events, but you keep your eyes on it, because right now credit spreads are compressed. If you see a few more major bankruptcies, credit spreads will start to widen, which will make it tougher for companies to refinance. That's the bad news. The good news is Chair Powell seemed alert to these risks today, certainly in employment, and basically said right before the blackout period, implied that another cut was coming. So on the one hand, you have a little bit of froth in credit markets and in some pockets of the equity markets. On the other hand, we're moving into an easing environment, which is going to help a lot of companies refinance. And maybe some of these bankruptcies were actually due to the fact that rates rose so quickly and have stayed restrictive for so long. And as that restrictive Fed policy comes out of the markets, it could actually put some tailwinds behind the economy. And I think the IMF was signaling as much today in their increased outlook of the global economy at 3.2%.
And Fed and Powell, as you mentioned, they'll be looking at all this data cautiously.
That's correct. Yeah, and Powell has intimated that he's now going to be less restrictive. He's alert to the dual-sided risk and predominantly focused on employment now. We've seen the tariff inflation come in less than expected, and the banks overall. We're focused on the negatives, but the positives are record banking profits. Animal spirits are back. Goldman Sachs investment banking revenue was up 42%. JP Morgan was up 16%. And then on the trading side, JP Morgan had up 25%.
Yeah,
so
good news
there's a
for
lot
banks,
of positive
for sure.
stuff happening.
Yeah, the banks will certainly be happy. Thanks very much, Tom, for that. Thomas J. Hayes there, chairman of Great Hill Capital. We'll have to leave it there.